Open your banking app right now. Go ahead, look at that number sitting in your savings account. It's higher than it was last month, higher than it was last year. Every single statement tells you the same reassuring story. You're doing fine. You're saving. You're winning. You're not. Somewhere between that number climbing and your actual life, something has quietly broken, and almost nobody's told you. The balance goes up. What that balance can actually buy you goes down, not eventually. Right now, while you read this sentence, that's not a glitch. It's not bad luck. It's math. Cold, deliberate math that most people never bother to run because the bank never runs it for them. So here's the question worth sitting with. If your money is growing every month, why do you feel poorer than you did a year ago? Stick around. The answer isn't complicated. It's just been hidden in plain sight. Here's what's coming. In the next few minutes, you're going to see the exact rate your bank is paying you right now. The real number, not the marketing number. You're going to see exactly how fast prices are actually climbing using the government's own data. And then we're going to put those two numbers side by side because that gap is where the real story lives. Most people assume they're roughly breaking even. They're not. The gap is wider than that, wide enough that it's quietly draining your savings every single year without you noticing a thing. And once you see it, you'll understand why a growing number of people have stopped trusting that number on the screen entirely and started moving their money somewhere the banks can't touch. Let's start with the number your bank actually pays you. According to Bankrate's survey of more than 500 banks and credit unions conducted in August 2026, the national average savings account is paying just 0.63% APY, not 6%, not 3%, 0.63. Sit with that for a second because that's the number sitting quietly at the bottom of your statement, doing almost nothing. Now here's the other side of the equation, the side your bank never puts next to it. The Consumer Price Index, the government's own measure of how fast prices are rising, came in at 3.5% annually for June 2026, and that's not a small move. Back in February of this year, that same figure was sitting at 2.4%. In just a few months, inflation didn't ease like a lot of people expected. It accelerated, sharply, in the opposite direction. So now put the two numbers side by side, 0.63% coming in, 3.5% going out, subtract one from the other, and you get your real return, the number that actually matters, the one no bank statement will ever show you. Roughly negative 2.9%. That's not a rounding error. That's not a bad month. That is your money, sitting in a savings account, quietly losing purchasing power every single year, even while the balance on the screen keeps climbing. And here's what makes this especially uncomfortable. This isn't some fringe calculation. It's basic subtraction, using numbers straight from Bankrate's own industry survey and the government's own inflation data. Nobody's hiding the math. They're just betting you'll never do it. But this gap, this negative 2.9% bleeding out of your savings, didn't just appear overnight. It didn't come out of nowhere. It's the end result of a pattern that held for years, one that savers quietly relied on without even realizing it. And earlier this year, that pattern broke. For years, there was an unspoken rule savers could count on. When the Federal Reserve raised its benchmark rate, banks eventually followed, and your savings account actually started paying you something worth having. That's exactly what happened between 2022 and 2024. The Fed hiked aggressively to fight inflation, and for the first time in over a decade, savers finally saw yields that felt like real money. It wasn't great, but it was proof the system still responded to pressure. Right now, the Fed's benchmark rate is sitting at 3.5 to 3.75%, held steady through 2026. By the old playbook, that should mean savings yields holding firm too, maybe even climbing. Instead, average APYs have kept drifting quietly downward. The Fed didn't cut. Banks cut anyway. And at the exact same time, inflation didn't cooperate either. Instead of continuing to ease the way it had been through early 2026, CPI turned and accelerated, climbing back up toward 3.5%. So you've got a Fed holding steady, banks lowering what they pay you regardless, and prices rising faster than they were just months ago. Three forces that used to move together are now pulling in three different directions, and you're the one caught in the middle. Here's the part that makes it worse. This squeeze doesn't hit everyone the same way. Where you keep your money, which bank, which account, even which side of the online versus brick and mortar divide you're on, changes how badly this gap eats into what you've saved. Some accounts are barely moving the needle, others are getting devastated, and the difference between the two isn't small, it's not even close. Here's where that gap stops being abstract and starts getting personal, because that national average we just walked through, 0.63%, isn't actually what most people are earning. It's a blended number, and blended numbers hide a lot. Underneath that average sits a two-tier system most depositors don't even know exists. On one side, you've got the big, familiar brick-and-mortar banks. the ones with branches on every corner, the ones most people have used their entire lives. Many of them are paying as little as 0.01% APY on standard savings accounts. Let that number actually land. 0.01%. Do the math on that. $10,000 sitting in one of those accounts earns you exactly $1 a year in interest. $1. You'd earn more finding loose change in a couch cushion. On the other side of that divide, online and high-yield savings accounts are still offering rates up to roughly 4%, competing hard for deposits, no branch overhead weighing them down. That's not a small gap between the two tiers. That's the difference between $1 a year and $400 a year on the exact same $10,000. So when you hear the national average is 0.63%, understand what that actually means. It's papering over a system where a huge share of depositors are sitting on the wrong side of that split, earning next to nothing, while a smaller, more informed group is capturing rates dramatically higher. In fact, many customers at the biggest US banks are still earning as little as 0.01% on traditional savings accounts, while competitive high-yield accounts are paying around 4% or more. And most people never even find out which side they're on, because switching banks feels like a hassle, and the big banks are counting on exactly that inertia to keep your money right where it is, earning almost nothing year after year. This isn't a rounding error in the system. It's the system working exactly as designed, and it raises an uncomfortable question. If the banks themselves are engineering this gap, who else is quietly benefiting from it at a scale far bigger than your savings account? That question doesn't stay small for long, because the same gap that's draining your savings account is exactly what's fueling profit somewhere else in the system. Think about what a bank actually does with your money. You deposit $10,000 and they pay you next to nothing for the privilege, 0.01%, if you're at one of the big brick and mortar names. But that money doesn't just sit there. The bank turns around and lends it out, invests it, puts it to work, earning considerably more than they're paying you. As of the first quarter of 2026, the average net interest margin across FDIC-insured U.S. banks was 3.31%, the spread between what banks earn on interest-generating assets and what they pay to fund them. That spread, the difference between what a bank pays depositors and what it earns putting that same money to work, is not incidental. It is in large part the business model. And right now, with the Fed holding its benchmark steady and banks under no real pressure to compete for your deposit, that spread is about as favorable to institutions as it's been in years. Which brings us to the Fed itself. Officials have held their benchmark rate steady through 2026, watching inflation that was supposed to keep cooling instead turn and re-accelerate back up toward, and arguably past, where they'd like it sitting. That's not a comfortable position for a central bank. Hold rates too long while inflation climbs, and you risk falling behind the very problem you're supposed to be controlling. Cut too soon, and you risk making it worse. But here's what matters for you. While that debate plays out in meeting rooms, the banks aren't waiting around. They're not required to pass along better yields just because savers deserve them. There's no rule that says the spread has to shrink. So it doesn't. It sits there quietly, benefiting the institutions holding your cash while your purchasing power erodes underneath you. This is the layer most people never see, not because it's hidden exactly, but because nobody's incentivized to point it out to you. The banks certainly aren't going to. And the Fed's job isn't to protect your savings account, it's to protect the broader economy, which leaves one obvious question. If the system isn't built to protect what's in your account, who is? That question has one honest answer. You are. Which means it's time to stop talking about this in the abstract and start talking about your money specifically. Let's say you've got $25,000 sitting in an average savings account, a solid, responsible emergency fund, exactly what every financial advisor has told you to build for years. At 0.63% APY, that account earns you roughly $158 over the course of a year. Not nothing. It feels like progress. Now apply the other number, the one that actually determines what that money can buy. At 3.5% inflation, the real purchasing power of that $25,000 doesn't grow. It shrinks. Using that negative 2.9% real return we calculated earlier, you're looking at a loss of roughly $725 in actual buying power over 12 months, not on paper. In reality, in what that money can put in your cart, cover on a bill, or stretch toward an emergency. Your statement shows a bigger number. Your actual wealth tells a different story entirely. And this isn't a one-time hit. It compounds. Do this same math again next year and the year after, and you start to see the real shape of the problem. A $25,000 cushion that feels safe is actually eroding quietly. Every single year it sits exactly where safe is supposed to be. This is the part that should genuinely unsettle you. You did everything right. You saved. You didn't overspend, didn't gamble it on something risky, didn't ignore the advice you were given for decades, and you're still losing ground. Not because of a mistake you made, but because of a system quietly working exactly as designed against anyone who leaves their cash sitting still. So if the account you were told to trust is bleeding value in the background, the real question becomes bigger than your household. It becomes about the entire system built on top of that same currency. Zoom out far enough, and your $25,000 stops being a personal problem and starts looking like a pattern playing out across the entire economy. This is not the first time cash has quietly lost a war against inflation while looking perfectly safe on paper. Historically, whenever real yields on cash turn negative, when what your money earns falls meaningfully below what prices are actually doing. Capital doesn't just sit there and accept the loss. It moves. It looks for somewhere to hide that isn't bleeding value by design. And for centuries, one of the places it has consistently moved toward is precious metals. Gold and silver don't pay you interest. They don't compound in a savings account, but they also don't dilute the way a currency does when the purchasing power underneath it keeps eroding year after year. That's not a talking point. It's the entire reason gold has functioned as a store of value across economic cycles that stretch back further than any bank currently operating. And this is exactly the dynamic that macro commentators keep pointing back to when they try to explain gold's recent price behavior. Spot gold is currently around $4,344 per ounce, roughly flat year to date, while spot silver is around $64.67 per ounce, down roughly 10%. Year to date, it. Quote S, not a coincidence that interest in these metals tends to climb in step with periods like the one we're in right now, a Fed holding steady, inflation re-accelerating instead of cooling, and savings accounts falling further behind by the month. You don't need to time a headline or predict a Fed meeting to see the underlying logic. When the vehicle you were told was safe is quietly losing to inflation year after year, it makes sense that money starts searching for an alternative that isn't structurally built to lose that same fight. This is bigger than your bank account, and it's bigger than any 1 year of CPI data. This is the same pattern that's shown up before in different decades, under different circumstances, for the exact same underlying reason: currency losing ground and capital looking for somewhere it doesn't. So the real question isn't whether this pattern exists. It's what you're supposed to actually do about it, sitting where you are, right now. Here's how you actually put this to work, starting with your own numbers instead of the averages we've been using. First, calculate your real return. It's simple. Take your savings account's APY, subtract the current CPI figure, and that's the true number, not the one on your statement, the one that reflects what your money can actually buy a year from now. If that number is negative, you now know, in concrete terms, exactly how much ground you're losing every single year by leaving that cash exactly where it is. Second, check where you actually stand. Don't assume you're earning the national average. Most people aren't. Look up your specific bank's current APY, then compare it against the top high-yield savings accounts available right now. The gap between them, as we've seen, can be the difference between earning $1 a year and earning hundreds. That comparison takes 5 minutes and costs you nothing. Third, and this is the part that requires real thought rather than a quick fix, consider how much of your cash actually needs to sit in a low-yield, inflation-exposed account versus how much could be positioned somewhere designed to hold its value against exactly the pattern we've just walked through. This isn't about abandoning cash entirely. You need liquidity. You need an emergency fund you can access immediately. But beyond that baseline, the question worth sitting with is how much of your remaining savings is quietly losing a fight it was never built to win. The World Gold Council's 2026 portfolio analysis found that adding allocations of 2.5%, 5%, 7.5%, or 10% to gold improved risk-adjusted returns and reduced drawdowns in its hypothetical diversified US dollar portfolios. Nobody can tell you the exact right number for your situation. But now you're not guessing blind. You're working from your own real return, your own bank's actual rate, and a clear-eyed look at what's been happening to cash sitting still. The math doesn't lie. What you do with it is up to you. Now, you don't have to take my word for any of this, because the people who track these numbers for a living are saying the same thing. Ted Rossman, senior industry analyst at Bankrate, has been watching this exact trend play out in real time. His read on where things stand: savings rates have been sliding, with further softening likely in the near term, but the strongest deposit accounts out there are still well above the inflation rate, which is exactly why shopping around matters as much as it does right now. Read that carefully, because it confirms everything we've walked through. This isn't a fringe theory. This isn't one YouTube channel connecting dots that aren't really there. This is Bankrate's own senior analyst on the record, describing the same two-tier gap we broke down earlier, a shrinking national average and a smaller group of accounts still managing to outrun inflation. The takeaway from someone whose entire job is tracking these rates professionally is the same one we've arrived at independently. Where your money sits is no longer a minor detail. It's the difference between falling behind and actually keeping pace. So let's bring it all together. Your bank is paying you an average of 0.63%. Inflation is running at 3.5%. That gap, nearly 3 points of lost purchasing power every single year, is quietly draining accounts that look perfectly healthy on paper. Underneath that average sits a two-tier system, big banks paying next to nothing, high-yield accounts still fighting to outrun inflation. Most people are sitting on the losing side without even knowing it. The pattern that used to protect savers, rates tracking the Fed, has broken. The Fed holds steady, banks cut anyway, inflation re-accelerates regardless. And historically, this exact setup is what pushes capital toward assets that don't dilute the way cash does. The takeaway is simple. Calculate your real return, compare your rate, and decide how much of your savings should keep losing quietly and how much shouldn't. So go back to where we started. Your balance goes up, your wealth goes down. That paradox isn't a glitch in your bank statement. It's the system working exactly as intended, and now you know exactly why. The only question left is what you do with that knowledge. If this opened your eyes even a little, hit subscribe. This is exactly the kind of pattern we track here month after month. And drop your current savings APY in the comments. Compare it to the numbers we just walked through. You might be surprised which side of that gap you're actually standing on.